My name is Margot von Aesch. I am a senior consultant here at Edelman Smithfield. Delighted to have you all here. It feels like the right moment in time to start talking about resilience, given that we've had so much to digest already in terms of uncertainty. We're going to talk about resilience in the face of uncertainty, but also from the perspective of asset owners. I'd say that asset owners have a lot to think about these days, not just about returns, but also about how to build robustness into their portfolios, and also how they get what they require in terms of that robustness from their asset managers and their underlying assets. So without further ado, I have a wonderful panel who will help me with this conversation in the shape of two outsourced CIO platform managers. We have Pat Race here from von Lanschot Kempen, and we have Niall Sullivan from Mercer. We also have a fiduciary manager specialised in UK defined benefit and defined contribution schemes in the shape of Peter Smith from TPT Retirement Solutions. And then also we have Kamhi here, who joins us from Federated Hermes Eos, who of course is a stewardship specialist who engages on behalf of asset owners and who will give us his perspective as well. So maybe we can start off by talking about the particular resilience measures that you might have taken in 2025 already, and adding to that, or you might have seen being taken, Leon, and adding to that, what you might want to do in 2026. And this is a question for everyone in the panel. So let's start with you, Pat.
Okay. Right, so just to set the scene, so we're looking at defined benefit pension schemes. So for me, all I really worry about is gilt yields, because that's what the actuary is using to value the pension scheme. So any move away from gilt yield is, for me, that's a risk. So there has been a need to build a lot of resilience, and no one can be 100% gilts. So we continue to be more credit-based rather than equity-based, because that is the more resilient method to fund defined benefit pension plans. So credit rather than equities. We've been a little concerned about the spreads on investment grade. So watching the bond panel a minute ago, we are diversifying away from investment grade credit. It just doesn't seem to be good enough value for money. In the equity space, where clients still need equity investment, and to be clear, fewer and fewer of our clients are reliant on equities to actually get themselves to full funding. We have been cap and collaring them, so putting protection on the equities, and that's felt to be a sensible move. And aside from that, just pure raw diversification. So we've been putting more money into different types of bonds, so more alternative credit. We've had an allocation to catastrophe bonds at the very senior end, which have delivered, I think, 12% this year, which has been a good place to be. In terms of what next, I think more of the same, to be honest. I can't see anything. April talking about angry presidents and so on a minute ago. I can't see things getting less volatile anytime soon. So I think the protection will stay, and certainly the skew to credit to keep portfolios strong is I think a permanent feature.
Thank you very much. Peter, your thoughts?
So similar theme to Patrick in terms of the gilt yield discussion. As a long-term investor, we are defined benefit and DC. We have 50 to 100 years of our liabilities to run. So inevitably, you want to make use of that and invest in private markets, and you've seen a big trend towards that over the last 10 years. The challenge then is, what liquidity do you maintain to manage resilience in a changing yield environment? So I think most of the DB market is still scarred by 2022 in terms of the significant rise in yields. It wasn't necessarily the level they reached, it was the pace at which they got there. So do you have enough liquidity to manage that yield move? And then the second bit is also, I think as a long-term investor, we are prime place to be liquidity providers in market stress. So think about what happened to credit spreads during COVID. That was a brilliant time to be the liquidity provider to credit markets. We can do that, but you obviously need to have the liquidity to move the portfolio around in a relatively short period of time. And if you don't have that, you can often be just at the whim of the markets and not being able to rebalance or move the asset allocation around. So it is liquidity, I think, is still the key, particularly for defined benefit schemes in the UK. In terms of next year, I think making better use of scenario modelling and analysis to inform asset allocation decisions. The market, a lot of my time is spent discussing with consultants who's got the right capital market assumptions, and the answer is they're all wrong. So nobody. This element of trying to determine precise outcomes for equities over the next 10 years, cash plus 4.3. We cannot have that level of certainty. You know, correlations move around, volatility doesn't stay constant. So how do we make use of scenario analysis to think about the regime we're in at the moment, which, you know, has already been talked about? It's higher yields probably for longer, higher inflation than expected, it's sticking around. You know, the old argument during COVID, is this inflation sticky? It's still around, so, you know, how do we cope with that? Equity market valuations at all-time highs and credit spreads at all-time lows. So what is the path forward to deliver returns for our clients?
So my role tends to be a little bit more global in that I'm looking after teams in multiple jurisdictions and multiple segments. So maybe drawing on some different themes, the ones that were just said. I think one of the big things that people are focusing on globally is this idea of the total portfolio approach and trying to think about what that means. In particular, what I think it's meaning for a lot of people, particularly at the larger end, sovereign wealth fund space, large investors globally, is they're asking themselves, how do they put diversification into their portfolio in a true sense? But also, how do they allow themselves to do that? Because if you say, I'm going to change the portfolio, but then you're going to measure yourself relative to MSCI or an aggregate benchmark over the shorter term, then you're not really going to be able to do it because your stakeholders won't let you. So a lot of people are thinking about how do they give themselves a diversification of asset class, and also increasingly a little bit more a diversification of where the manager themselves are located, so that the manager can bring some independent thought to the portfolio in addition to what they're seeing. In terms of themes for the next 12 months, actually building on something that both Peter and Pat raised, a lot of investors globally are running into this liquidity challenge, now for different reasons, but say a number of endowments and foundations in the US have suddenly found themselves wondering exactly what their liquidity needs are and what does that mean. That is creating some interesting opportunities to be a liquidity provider. So asking yourself that the people who have liquidity to use, making sure that they can continue to use is a real theme. Because if you say you're going to vintage diversify, I mean, if you have an overarching reason to do it, like a defined benefit pension scheme has, completely understood. But otherwise, then vintage diversification relies on continuing to turn up and vintage diversify, and that's part of it. Maybe the last thing I think, and this might link a little bit to what Leon will talk about in some ways, is we do our large asset owner survey, and one of the things that you saw year on year is that the amount of people focused on what we would have historically called sustainable investing has actually gone down. But it's been more than offset by a amount of people focusing on impact investing. And in particular, I think what you're seeing is people are beginning to ask, how can I do things that are more societally impactful, relevant to me and my stakeholders, and how would I measure that I've actually done it when I've done it? And that, I think, is another area that those large asset owners are focusing on.
So as Niall said, I might take a slightly different tack, and I do run a stewardship service for over 70 institutional investor clients. Most of them are what one calls a universal owners, so they're very interested in the long term, and they're also widely invested in the economy. So I would say, in terms of answer to your question, I'm going to give a general answer. We engaged with companies to increase the resilience and improve the alpha and reduce the risk getting that alpha. But we also engaged with policymakers and best practice. And on best practice in order to try and get to that beta, which matters a lot to our clients. And if I go forward to, well, what might happen in 2026, so I'll try and give a more specific answer. I think what's really critical is that policymakers and companies, there's a gap between them. Policymakers doing their regulation in their own little bubble, not really thinking hard enough about what impact it might have on companies. And I think we all need to get more real in the sustainability side. But stewardship's broader than sustainability, but certainly in the sustainability side, companies do need to earn returns, and governments need to have low energy costs for the citizen. So how do we make that happen? And maybe taking more of a longer term approach, investing now to have future returns, maybe the answer for future resilience.
Brilliant, thank you very much. And maybe continuing on that sustainability theme, a recent report by Karna Earth talks about natural capital as an investment class which is emerging. Their stat is that 92% of local governance pension schemes thought that in addition to financial returns, contributing to climate adaptation and mitigation is a leading reason to invest in natural capital. we've talked about the liquidity, the need for liquidity. Peter, can I ask for your thoughts on natural capital and the investment opportunity it represents?
Yeah, so the first thing is natural capital is not new. It's been rebadged as used to be called just timber and agriculture. So it's not a new asset class. It's, we've had them for quite a long time. So you can see where this has come from, and we looked at this around 10 years ago in terms of just more the timber element. The background I think as to why it is becoming more prevalent around certain types of investors. You think about, we started off with climate. That's quite easy. We came up with a climate policy in 2012. It was clear it was becoming a theme. People are then saying, well, how do we make our portfolio robust to different climate outcomes? What is stranded asset risk? And that's obviously led to certain portfolios just looking to reduce outright their level of carbon intensity in their portfolio. So that was sort of, Paris Agreement, TCFD coming in, investors around the world focusing on climate. But then the next thing is, well, climate's one element, but obviously the conversation then goes to biodiversity. How do we think about creating resilience to biodiversity within the portfolio? And there's obviously two ways you can do it. You can think about what the exposure you already have. So we already invest in companies. Inevitably, they have biodiversity, being timber, agriculture, within their supply chains already. So how do you manage that risk? And then how do you make more of a positive impact? So how do you actually get direct exposure to these assets? The increase in private markets we talked about, buying timberland and agricultural assets directly. So I think that's where it's come from. And obviously, TNFD coming out in 2023 has advanced that. At the time, I was expecting that would become, part of UK regulation at some point in the near future. I'd probably roll back on that. I don't think that's probably going to be the case. So long we're to get why are we here. So I think there are certain investors that perhaps have particular stakeholders that don't necessarily just focus on risk return and liquidity. There are other things they're trying to do with their portfolio. To Niall's point around, do you have a mandate to invest in your local economy, improve the lives of the people around you? That then naturally leads them, I think, to looking at, well, agriculture, clearly it's quite an important part. How do we have food stability, food prices? We looked at it. I think the problem you have is, from a risk return perspective, it's relatively low returning. It's, I'm sure people tell me slightly different after. High single digits, it's relatively low yielding, and you're looking to lock your capital up for 15 to 20 years. In an environment where you can buy a high yield bond and get an 8% all-in yield, it's not that attractive. When rates are on the floor, there's potentially a different argument. So unless you have a specific requirement or stakeholder that requires you to do that, I think at the moment it's quite difficult to figure out how it fits into the portfolio given other opportunities that are around.
Thank you, Peter. Leon, do you have anything to add to this?
Yes, so building on what Peter said, nature is embedded in our economy and frankly drives the value in the economy. So everything we do requires nature in order to be successful. It's not only current economic activity but also potential future growth. I think a GFI report back in 2024 suggested that 12% of UK GDP is at risk if we don't address nature degradation and the like. So it's absolutely critical, and we engage with both companies and policymakers. The companies typically in food and beverage, mining, apparel, banks, in order for them to understand what potential impact they might have on nature or what benefit they might have on nature. And we're pleased to see, as Peter said, there's 700 TNFD adopters, and disclosure is the first step. But then in the future, it's got to also be about action, whether it's action in regenerative agriculture, wherever it might be. So yes, do see real opportunities in terms of investing in natural capital. But one does have to be careful here. Again, those investing in natural capital need to make a return. And policymakers might need to provide the right incentives for that to happen. But there is a risk to the economy, so it is something which is material and likely become material for companies.
Thank you. I'd like to move to our investor pulse, which has been referenced by some of my colleagues already. We asked 300 investors in the US and Europe in total a number of different questions. And the question for this panel was, which factors are the biggest influences on asset owners when mandates are awarded? I'm going to let that settle for a moment, because effectively we're asking this panel to comment on the fact that we asked investors what they thought that you would look at when you select them. Now, the answers to those, the highest scoring, the most influential elements, were a strong brand and a strong performance track record. I'd love you to respond to that, bearing in mind, of course, what it is that we do at Edelman Smithfield. Niall, can I get you to start on this, please?
Well, to be honest, I was actually just trying to struggle to keep up with the question. Is it what they think we think that they think?
Yes.
So I think the phenomenon you talked about, I would recognise very strongly in a lot of global marketplaces in the more retail side of things. That it is definitely the case that you would expect, you know, a strong brand and a strong track record to be the thing that would attract people in. I've always felt that maybe at the more institutional end of the market, we'd probably been a little bit more nuanced. The strong brand hopefully speaks to a strong management that will enable people to be the best investors they can be at the firm, and that does matter. I think the strong track record has to be taken with a real degree of caution. And the example I would give is, if we take somewhere like private credit at the moment, it's clearly been a very interesting place to invest. It's clearly got a lot of interesting returns, but it has not seen a proper credit event really since the GFC. I mean, there was some humps and bumps around COVID, but the authorities stepped in to fix it very, very quickly. So the type of firm that is likely to do well if we get some sort of economic slowdown is the one that's likely to be doing, relatively speaking, a little bit worse at the moment, because they're going to keep that protections and risk part of their process and not compromise on covenants and the things that come with it. So I think track records matter, but you clearly need to be very careful that the underlying characteristics of the manager are going to drive the performance that you want going forward.
Absolutely. Pat, would you like to build on that?
Yeah, I mean, Niall said it very diplomatically, but I think when I first saw the results, I think my reaction was, I mean, that's an absolutely terrible idea to pick based on brand and track record. It's just nonsense. I mean, taking them one by one. So, brand. There's been some really big brands that have completely disappeared. So, you know, I don't want to name names, but we can all look back to, you know, the dot-com times and the big brand investment management companies. They simply don't exist anymore. So I park brand to one side. And when I think about track record, I think, well, past performance ain't necessarily a guide to the future. So again, that would probably fall away. I mean, Niall's absolutely right. This is retail space, and you know, if I'm Joe Bloggs on the street, finding someone who I recognise and someone who's done all right is clearly a good idea. But the way that we do it as fiduciary managers and as investment consultants is much more subtle than that. So you would be looking for teams who can demonstrate persistent skill, and you know that is a hard piece of work to do, just to understand how they deliver their performance. You'd be looking at track record in different time periods, because as Niall was saying, a manager that did well over a particular period isn't necessarily going to be doing well in the future. So understanding how their methodology actually tracks in different markets. You'd be looking for quality of management, and that does potentially go with brand, but you'd also be looking for an ability to explain what they do. And if they can't tell you how they're investing, I would run a mile. And a degree of humbleness as well. I hate it when money managers say, you know, this is how I'm performing, this is going to happen forever, because that's clearly not the case. So there's a subtlety and a relationship management that needs to come into this. And it is really hard to do. And, you know, obviously you can hire consultants to help you with that. But if you can't do it, you hire a passive manager and you just let it go. And to hire a passive manager, you're looking for tracking accuracy and fees. It's a completely different situation.
Yes, and actually fees came in third,
Yeah.
at a very narrow margin though.
Yeah.
Interestingly also, what came in last, but again with narrow margins, were the ESG credentials of an asset manager. Anything to add to this, Peter, before we move on?
No, I think the three I would have is alignment of beliefs. You know, as asset owners, you should have a set of beliefs about what type of manager can add value, and that should be different depending upon the asset class. So what might suit a long-only equity manager may not suit a multi-asset credit manager. You might need different platforms, different skill sets, different business models. So an alignment of beliefs of how they go about doing that. It's transparency, particularly in private markets and complex asset classes. If you don't get the transparency, how do you actually know how they're delivering returns? The best time to do that is due diligence at the outset, asking the right questions, and then consistency. Do they do the thing you expected them to do? A good example is maybe a value manager over the last 15 years have had a pretty hard time in delivering returns. But that should be our decision as an asset allocator, not their decision in terms of style drift. We own some decisions, and you hope that the decisions you own are then implemented. But if the style doesn't work, we will make the decision to move away from not expect the manager to necessarily do that for us.
Understood. Thank you very much. I'd like to move on to performance measurement. We've already touched on how risk and return may not be enough to assess the performance of some of those asset managers, particularly in the context of resilience. Leon, can I ask you, from your vantage point, what you think should be incorporated into performance measurement?
So I think it's really important to certainly look at returns and returns relative to the benchmark, maybe focus more on the long-term returns rather than what happened over the last 3 months. But I also think it's quite important to look at the underlying performance of the portfolio. And what I mean by that is if it's one made out of companies, it will be the sort of aggregate company performance. What's happening there in terms of growth, in terms of profitability, in terms of level of debt, how much cash or it's dropping off, dividends, etc. But that's the underlying performance and what the potential, how that might evolve. And not separately, but in an integrated fashion, also look at a number of the material, environmental or social performance. So it could be around carbon, could be around water, could be employee turnover, those sorts of things. So that gives you an overall view of what this portfolio is invested in, where the risks are and where the opportunities are. And then what is the investment manager doing in terms of engaging with those risks and engaging with those opportunities? So if you've got risks and opportunities all in carbon, are you engaging on the carbon? Are you engaging on corporate governance? Where is that engagement happening? And is there progress being achieved on that engagement? And I think some stewardship statistics, don't get me wrong, on a report you have to dig in and dive in and look at what's going on, etc. And what do those case studies say? But I think that would add a huge amount. Because I think what we provide as an investment manager, and I am part of investment manager, is certainly we try and buy low and sell high, by investing away from the benchmark, but we also should be looking after the asset for you. Yeah. And that's really important. And that's not necessarily looked at as much as I think it should be.
Okay, thank you. Staying with you, I wanted to move on to public and private assets. I'll be asking your fellow panellists about their allocation to public and private, but what I wanted to know from you, Leon, is how has stewardship and engagement evolved in the private markets, and how does that compare to the public markets at the moment?
So most of the noise is around public markets, but I would say the truth is there's probably more stewardship and maybe more impactful stewardship happening in private markets. So what is stewardship? It's with a company, it's about, in my view, it's about empowering the company to do things it otherwise wouldn't do, because maybe they're worried about what their short-term performance be, and you're empowering them to take more of a long-term position, or it's holding them to account when they're not doing what might be in the interests of shareholders. Now, as in private markets, you typically, not always, but you typically have much bigger stakes. If you own 100%, then you're not engaging so much, you're managing. But if you're one of 3 or 4 major holders, you do really have the leverage to engage. So if I just very briefly take a real estate example, and there are many, but the work which we've done together with our partners in King's Cross is to get really great social and environmental benefits and a really good high return from that investment. And that's been engaging with the manager there, engaging together with our co-holders to try and make some of those things happen. So I think stewardship is alive and well in private markets.
Thank you very much. In the interest of time, very quick views on public versus private and where you think that might go from here.
Okay. Well, it kind of depends. I mean, it depends on I mean, if you're a pension scheme or an investor with a defined time frame. So, for example, you're looking to buy out, then you're not going to be in private markets, and you're trying to cash it out as quickly as you can. So that would be a fully public focus. If you're a pension scheme that's trying to run on for 10 years, and more are doing that, then if we're trying to create a gilt plus 2% return, that could trolley down to around about 15% in private markets, usually private debt. So, a fairly decent allocation to private assets. Now, in terms of where it's going, I really do think that the trend to run on is gathering a lot of pace. There are better funded pension schemes out there than throughout my career. This is, the golden time. The government, the Mansion House sort of mandation tango, whatever we had it last year, where should we mandate, shouldn't we mandate, should we chillax, I think was the phrase at the Pensions UK. I mean, all that doesn't really matter, because tucked away in the budget we're softening the basis to allow people to be slightly better funded before they can start returning money to members and the company. So I think that will happen, and I think that will push us into longer dated assets, and that will mean more private.
Okay, great. Thank you. Peter?
Yeah, I think the overall allocation might not change, but where it sits, to Patrick's point, it changes. It's moving away from corporate DB. They just won't own it in the next 20 years because they'll either be in the insurance market or something else. It's moving into DC. The challenge there is how do you get it in, given the charge cap and I think the value for money framework. It's moving into collective defined contribution. That's coming in a couple of years, and the fourth one is then it's moving into super funds to facilitate run on, but without a sponsor. So the allocation might not change, where it sits will, but that does have an impact on people's willingness to pay fees. The structure that takes, whether that's a closed-ended vintage or an open-ended fund. So the product that sits around the illiquid asset will need to change to accommodate those different benefit structures.
Great. Niall, anything to add to that?
Yeah, I'd probably add maybe three things. I think, first of all, while we put private in front of debt and private in front of equity, still debt and still equity. So I think when you look at your portfolios, you've got to figure out how you're looking at it in the entirety. Just because it doesn't mark doesn't mean the exposures aren't there. Yeah. So you need to be asking, if you're going to put these into your portfolios and you're in a different landscape to what the guys have just described, how are you going to be thinking about the true risk exposures that you're actually facing and running it as a result? I think the second thing would be implicit, again, in what Peter and Pat have been talking about, is this idea that there's parts of the world that are not allocating. That means there's parts of the world that need capital now. So what are you getting that you didn't get before if you're going to give them capital? So we're not necessarily seeing big price or fee falls. You are seeing, though, that you're being given more co-investment at zero fee and zero carry, which lowers the overall cost of ownership. So you really should be asking yourself, if you're in the fortunate position to be allocating, what are you able to take advantage of? And third, and I touched on it already, that in private credit you have this idea of, well, you haven't been through a crisis. In private equity you have a different challenge, which is that to some extent up until recently you were able to buy a company, lever it and sell it on, right? You're not going to be able to do that at these starting valuations and these debt levels. You're going to have operating excellence to turn the company into something better. When you're talking to the manager and they're showing you all their fancy charts and telling you all the way they can help, show you how they have actually made the companies that they invested in before better. Yeah. And if there's an awkward silence at that point, I'd take the next meeting.
Brilliant. Thank you very much. I was going to ask a really interesting AI question, but I'm going to have to drop that in the interest of time. So I'm going to move on to Q&A from the audience, if there aren't any, with the few minutes that we have left.
Thank you. Dominic Webb from Responsible Investor. We, over the past couple of years, have seen a few large mandates moved in the Netherlands, in the UK, in the US, where responsible investment was a major factor, if not the only factor. Do you think that's a trend that's going to continue, and where do you think these mandates are going to move to?
Who would like to do that one?
I'm happy to have a shot at it overall. I think that what you're seeing is that investors want, or the asset owners want, the people that are managing their money to be aligned to what they believe on an ongoing basis. And companies are going to have to make choices as regards what they want to do in that context. And at the moment that every reformation tends to be followed by a counter-reformation. There was a move that a lot of people went one way before. A lot of people now, because of political pressures, are potentially going the other way. But I think you're right. The thing that will correct that and make people do the right thing will be that. I think the key to it is to be investor-led, and to bring some of the ideas that Leon talked about earlier. To be a good steward of capital and to make the companies that you're owning better is something that everybody should want to do.
Thank you.
Actually, just to follow up on that, it feels like there's a clear misalignment between timeframes of asset owners, beneficiaries, the planet, natural capital, and then on the other side, perhaps investment managers or the finance world. And I guess my question is, what can be done to address, to make these timeframes more aligned? And by whom should it be done? Because we've had broadly this conversation many times before, and it feels like that misalignment is as strong as it ever has been.
Who would like to have a stab at that question?
I mean, it's the principal agent problem, right? You sort of you give your money to somebody, and then there's multiple participants in the financial market. I'm not sure I agree it's the worst it's ever been. I mean, the things we talk about in terms of the transparency around TCFD, TNFD, that's come because there's been regulatory change, but also investor appetite for these things. The time frame problem is one that is hard to solve because...
And one we're running in.
Yeah, I mean, okay, so quick one is, ultimately, the regulation around how benefits are structured and how they're valued, that is ultimately what drives investor time frame. So if you can handle illiquid private markets or volatility through regulation, that ultimately helps you extend out your time frame.
Thank you very much to our panellists, to our audience for being here. Wonderful, thank you.